Here's something that might completely change how you think about property timing and cycles. There's this theory called the 18.6-year property cycle that's been getting a lot of attention lately. Some investors are pulling out of the market or holding off on major purchases because they're convinced we're about to see a massive crash in 2026. But here's what's interesting. I've been diving deep into this theory, looking at over 350 years of data from the UK and the US. And when you actually apply it to the Australian market, the story becomes a lot more nuanced than most people realize. I'm Steve Palise, and I'm a buyer's agent and an investor myself. And I've seen what happens when people make decisions based on fear rather than data. So I'm gonna break down exactly what this cycle is, how it's played out in Australia historically, and most importantly, how you can use this knowledge to make better, more informed decisions about when and where to buy a property. Let me start by explaining the theory behind the cycle. The 18.6-year property cycle was first identified by Fred Harrison, who analysed over 350 years of UK housing data. Then Phil Anderson took it further, studying 250 years of US property data and wrote about it in The Secret Life of Real Estate and Banking. Here's how it works. You get roughly 14 years of rising prices with a mid-cycle dip around the 7 to 9 year mark, followed by about 4 years of declining stagnation. The people who truly believe in this cycle will tell you it's a crystal ball for property markets. They reckon you can use it to predict exactly when to buy, when to sell, and when to hold off. And I get why that's appealing, especially when you're staring down a property purchase that might be the biggest financial decision of your life. The whole thing sounds beautifully simple, right? Instead of trying to figure out interest rates, supply constraints, population growth, local infrastructure, all the messy, complicated stuff. You just need to know where you are in this 18-year pattern. Recovery, boom, correction, repeat. And when markets are all over the place, when you've got experts saying one thing and other experts saying the complete opposite, having something that claims to keep it simple, well, let's just say, I understand why people gravitate towards it. But does it actually work when you apply it to Australian data? Can you really identify which phase we're in while we're living through it? And most importantly, does following this cycle actually help you make better property decisions than focusing on the fundamentals? So let's test that theory. If we apply this cycle to Australia, starting from the GFC in 2008, the timeline would look like this. Recovery phase from 2009, then a mid-cycle dip around 2016, and a boom from 2018, followed by the correction phase around 2021. But here's what actually happened. The recovery phase from 2009 to 2012 actually did play out roughly as the theory predicted. Following the GFC downturn, housing markets, particularly Perth and mining towns, softened significantly as the resource sector slowed down and speculative investments dried up. But here's the interesting part. Much of the East Coast was insulated from the sharpest falls thanks to our diversified economies and aggressive stimulus measures from the government. We had record low interest rates, continued population growth, and gradually stabilizing confidence, which marked the start of what looked like a gradual national recovery. But then, instead of a mid-cycle dip, we actually experienced a boom phase between 2017 and 2021, but only across 2 states. Sydney and Melbourne went absolutely mental, and I mean that literally. Property prices in some suburbs doubled within 5 years. I remember looking at properties in 2012 and then seeing the exact same property sell for twice the price in 2017. It was unprecedented. Nationally, the median house price rose more than $800,000 by 2017. This boom was driven by easy credit, strong migration numbers, and sustained economic growth. Perth completely diverged from this pattern. While Sydney and Melbourne were booming, Perth remained subdued because the mining boom was unwinding. So not only have we already gone slightly out of sync with the proposed property cycle, we're also starting to see different cycles in different markets. Then we had the mid-cycle dip between 2018 and 2019. This was thanks to the Royal Commission reshaping banking practices and APRA tightening lending restrictions. Suddenly, Sydney and Melbourne saw declines of around 10 to 15% from their peaks. Other capitals either stagnated or saw only modest growth. But even here, the dip was shorter and shallower than what the 18.6-year cycle would typically predict. Then 2020 happened and we went straight into another boom phase. The pandemic years marked what I can only describe as an extraordinary resurgence that no cycle theory predicted. We had ultra low interest rates, massive government incentives, and suddenly everyone wanted to move into regional areas and lifestyle markets. This drove one of the strongest property booms in Australian history. Property values surged nationwide with double-digit growth across both capitals and regions. Perth, which had been lagging for years, suddenly emerged as a standout performer, fueled by interstate migration and relative affordability compared to the other major cities. So, based on that boom, we should be entering what is called the winner's curse phase right now. The winner's curse is the final phase before a major correction. It's when late adopters pile in, driven by FOMO, low interest rates, and the belief that this time it's different. According to this theory, this phase typically lasts around 2 years and is characterized by speculative buying, maximum leverage, prices disconnected from fundamentals, and everyone thinking they're a property expert. If the cycle holds, this phase should peak around 2026, followed by a significant correction. Now, before you panic and think I'm predicting a crash, I've already mentioned we're slightly out of sync with the cycle. More than that, Australia has never experienced the 20 to 40% corrections that the cycle suggests. Our biggest downturn was Sydney dropping around 15% between 2017 and 2019. According to Domain data going back to 1994, national averages typically only dip around 3% from the peaks before an upward trend resumes. That's because we have significant economic factors that other markets don't have. For example, we have a structural undersupply that can't be corrected quickly. Also, in the US or the UK, when demand spikes, developers can relatively quickly bring new supply online. In Australia, however, we have skill shortages, material costs, regulatory hurdles, and coordination problems between different levels of government. You can't just flip the switch and build more houses. Our population growth is also policy-driven and unpredictable. The cycle theory assumes relatively stable demographic trends, but Australia's population growth comes largely from immigration, which changes dramatically based on government policy. When migration surges, it creates demand shocks that don't follow predictable 18-year patterns. Another factor is that Australian property represents around 70% of household wealth. That creates massive political pressure to prevent significant price declines. Governments will always intervene through first home buyers grants, stamp duty concessions, foreign buyer taxes, and whatever it takes to prevent a crash that would wipe out most Australians' wealth. So, if we're in the winner's curse phase right now, we should be seeing certain warning signs like massive speculation and over-leveraging, prices rising beyond all fundamentals, a universal boom across the markets, credit flowing freely to anyone, and general market euphoria. But here's what the Australian data actually shows. Yes, some markets are still growing strongly. Perth, for example, has seen 82% growth over 5 years. That definitely looks like boom territory. But Melbourne actually declined by 3.3% in 2024. Sydney's growth has been much more moderate at 35% over 5 years. If we were truly in a synchronized national cycle, all markets should be moving together. Instead, we're seeing a completely fragmented performance. Regional property has outperformed capitals by over 20% in the past decade. Not what you'd expect when most people think only the capital cities grow. In 2024, 72.6% of regional suburbs recorded increases, while values in 48.6% of the capital cities actually showed a decline. This fragmentation is actually a crucial test of the cycle theory. If the 18.6-year pattern is driven by fundamental macroeconomic and credit cycles, it should affect all markets relatively similarly. The fact that we're seeing such divergent performance suggests something else is driving the Australian property markets. So here's what I think is really happening and why the traditional cycle might not apply to Australia the way it does elsewhere. The 18.6-year cycle assumes that property markets can self-correct through supply and demand. When prices get too high, new supply comes online, demand cools, and the prices fall back to a sustainable level. However, Australia has a structural issue that undermines this assumption. We're not just a little bit behind on housing supply, we're catastrophically behind. Despite targeting 1.2 million new homes by 2029, approvals in 2024 were 30% below the annual target of 240,000. The NHSAC forecasts a shortfall of around 262,000 homes by 2029. This is a fundamental constraint that changes how our market is going to behave. In my opinion, interest rates are another major driver of Australian property prices. When rates rise, borrowing capacity falls and prices moderate. When rates fall, the opposite happens. Data shows that in the 2 years after a rate cut cycle begins, property prices typically increase by up to 20%. The RBA has been making cautious rate cuts, and experts forecast the cash rate could drop to 2.9% by December 2026. So, if you're following the 18.6-year cycle, you'd be preparing for a crash. If you're following interest rate cycles and supply fundamentals, you'd be seeing potential for continued growth, especially in the undersupplied markets. Now, let me directly address the cycle prediction. What if I'm wrong? What if the 18.6-year cycle does hold true and we are heading for a major correction around 2026? Here's my honest assessment. Even if property prices dropped 15% nationally, which would be the biggest drop in Australian history, what would that actually mean for long-term investors? If you bought an $800,000 property today and it dropped to $680,000, you'd still own the same asset generating the same rental income. If you're not selling, the paper loss is temporary. And based on every historical example, it would recover within 2 to 3 years. But here's the bigger risk that I see playing out repeatedly. What if you wait for this predicted crash and it doesn't come? What if structural undersupply, falling interest rates, and continued population growth keep supporting prices? I've had clients wait 3 years for crashes that never materialized. During those 3 years, the properties they were considering increased by $300,000 to $400,000. Their attempt to time the market crash costed them far more than the potential correction would have. The cycle theory might be academically interesting, but it's not a reliable basis for investment decisions in the Australian context. Our market just has too many unique factors. So here's what I think the real opportunity is right now, regardless of cycle theories. We have a market with a genuine structural undersupply. We can't build houses fast enough to meet demand. Interest rates are falling, which improves borrowing capacity. Population continues to grow rapidly, and these are the fundamental drivers that actually matter. But as I've mentioned before, not all markets are equal. You need to be selective about where and what you buy. Some areas have already seen substantial growth and may be due for a breather. Other areas are just starting their growth phase and affordability constraints push buyers outward. The key is focusing on local fundamentals rather than trying to time some national cycle. Look for tight vacancy rates, planned infrastructure, population growth, and reasonable affordability. These factors drive real estate demand, which drives sustainable capital growth. Based on that, instead of trying to predict where we are at some 18-year pattern, focus on these market indicators. First, interest rate trajectory. Rates are likely to continue falling, which historically supports property prices. This is happening now, not in some theoretical future cycle phase. Second, local supply and demand fundamentals. Look for markets where vacancy rates are tight. Under 2% is strong, under 1% is very strong. Look for areas with planned infrastructure, population growth, and limited new supply coming online. Third, affordability relative to local incomes. Markets where median house prices are 6 to 8 times the median household income are generally sustainable. Markets at 10 to 12 times income are vulnerable to correction if other factors change. And fourth, rental yield and rental demand. If you can't get decent rental returns and there's a soft rental demand, that's a warning sign regardless of cycle theory. That's it from me. If you want help analyzing specific markets and properties based on actual data rather than cycle theories, that's exactly what we do at Palise Property. We focus on the fundamentals that drive long-term returns. I've left a link below to book a call. See you guys.